Think about the biggest, most spectacular business failure of the last decade. You probably picture a technical flaw, a market shift, or a product nobody wanted. But this story isn't about code or real estate or even money. It's about ego. It's about the $47 billion lie a charismatic founder told to the world and himself. I'm talking about WeWork. At its peak, it was valued higher than established companies like Ford. Its mission was to elevate the world's consciousness. The story begins with Adam Neumann, an Israeli entrepreneur with infectious energy and a messiah complex. He wasn't selling office space, he was selling a lifestyle, a community. He convinced SoftBank's Masayoshi Son, one of the world's most powerful investors, that WeWork wasn't a real estate company, it was a tech company, deserving of impossible valuations.
Did you want to invest more in WeWork?
Of course. I still, I'm so excited, and if I could increase, I would like to increase.
But the numbers told a different story. WeWork was losing massive amounts of money, signing long-term leases and using short-term revenue to fund a party. The culture itself was defined by excess, massive corporate parties, tequila shots at board meetings, and a relentless focus on hustle over profit. Neumann even launched absurd ventures like WeGrow, a private, expensive school based on his wife's vision, further stretching the company's focus away from its core model. This hyper-aggressive growth environment created a bubble of delusion, and this is where our first psychological bias kicked in, the irrational escalation of commitment. Once you've invested a lot, your mind tells you to double down. Son had poured billions into WeWork. To admit failure meant losing face and money. So they kept investing, believing that more money could fix a flawed business model. They didn't just invest, they increased their bet exponentially, throwing good money after bad simply to justify the original decision. This is a classic cognitive trap, fueled by the hope that the next investment will finally be the one to rescue the past ones. The second bias is what sealed the fate of the company, confirmation bias. Neumann lived in an echo chamber. He only surrounded himself with believers. Anyone who questioned the burning cash or the absurd mission was immediately pushed out. This created an environment where only positive news and aggressive projections were accepted, reinforcing the founder's already immense self-belief. This is the dangerous lesson. When you reach the top, you stop seeking truth and start seeking validation. WeWork's board members, blinded by the potential money, played along, confirming his delusions. The dissenting voices were silenced, and the dangerous narrative continued unchecked. But the true spectacle of this collapse was the cult of personality. This brings us to bias number 3, the ego trap. Neumann saw himself as indispensable. His need for control and status directly impacted the financial stability of the company. He trademarked the word "we" and sold it to his own company for $5.9 million. This was not only a clear ethical violation, but a symbolic act of ownership over the very soul of the business. He bought buildings and leased them back to WeWork, becoming his own landlord, a monumental conflict of interest. Furthermore, key financial roles were often filled by family members, further obscuring the transparency and independence required in a multi-billion-dollar corporation. These were financial conflicts of interest that screamed fraud. Why did investors ignore this? Because the ego trap isn't just about the founder, it's about the investors who believed the founder was a genius who couldn't be replaced. They were trapped by their own narrative of the visionary founder. Their belief in his charisma outweighed their duty to financial prudence. This phenomenon, where the founder's perceived genius justifies any unethical behavior, is one of the most dangerous dynamics in modern venture capital. When WeWork prepared for its 2019 IPO, the prospectus revealed the horrific details: massive losses, bizarre spending, and leadership deeply intertwined with the company's money. The filing was a 300-page portrait of corporate recklessness, revealing that the company was not close to profitability and was riddled with governance issues. This exposed the final fatal error: groupthink. All the initial investors, the powerful VCs, SoftBank, had agreed it was a genius idea. When you are surrounded by powerful, smart people who all agree, your brain shuts down the critical part. Nobody wanted to be the one voice that said, "The emperor has no clothes." They had too much to lose: reputation, future deals, and the validation of their own investment strategy. The pressure to conform within the group became more powerful than the pressure to be truthful. The IPO failed spectacularly. The investor skepticism, once suppressed by groupthink, exploded in public view. The valuation dropped from $47 billion to under $8 billion in weeks. Adam Neumann was out. The lie was over. WeWork survived, but its cautionary tale is a masterpiece of human psychology. It's the perfect illustration of what happens when ambition overrides analysis. Even Masayoshi Son publicly admitted that his judgment had been poor in supporting Neumann so heavily, but the damage was done, requiring a massive bailout just to keep the company from bankruptcy.